Futures are a little changed, but politics is going bonkers and inflation comes in hot. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, fresh eco data, Trump's agenda, and more earnings rolling in. Morgan Stanley's Mike Wilson is going to share his playbook.
Disney delivers. The entertainment giant posts streaming success thanks to blockbusters like Inside Out 2 and Deadpool and Wolverine.
And a fashionable deal dissolves. Capri calling off its merger plan with Tapestry following regulatory hurdles. All of that and more coming up. But let's take a look at where markets are trading 30 minutes until the bells ring. It's pretty quiet. The S&P 500, it changed pretty much. It closed at unchanged levels yesterday. You take a look at where we are pre-market, even after that hotter than expected PPI data, and we're maybe a little bit lower, but pretty much dead even. You take a look at the NASDAQ 100, your big tech names, a little bit more movement, but down just a little bit. And even the bond market, pretty quiet right now. Of course, we had some intraday movement after that PPI data came out. We also had initial jobless claims, but you add it all together, the 10-year Treasury yield currently hanging out at about 4.45%. Matt Miller, these are very high levels.
Yeah, but so calm after PPI comes in 50% higher than the market had anticipated, at least on the core monthly. Look at this chart. I thought we rotated into a broadening market during the summer, but this is the S&P 500 as it's weighted, right? Mostly Mag 7 stocks, and this is the equal weighted index. Huge divergence. I'm going to ask Mike Wilson what this means in just a few minutes.
Sometimes stories just never change. I'm excited to talk about that as well. Let's look at some stocks to watch, because here's a story that's changing. Disney surging after posting fourth quarter sales that beat estimates. They're forecasting earnings growth for the next 3 years. Take a look at Disney, now up almost 9% pre-market. People like what Bob Iger is putting down. Meta, on the other hand, down more than 0.4% right now. It is lower after getting hit with an $841 million fine from EU regulators over antitrust violations. I am also keeping an eye on Capri and Tapestry. They are moving in opposite directions after ending an $8.5 billion plan to merge. Capri is now down almost 6%. Tapestry up more than 8.4%. Matt, we'll take a look at that. I have wondered if this deal would come back in the next administration. This was an antitrust story, after all, at the beginning.
Yeah, I love that story. I mean, I shudder to think how much money Tapestry has paid to finance this deal, and now to throw it all away in the face of an FTC with a boss who's so likely to get fired by the beginning of next year. It just, to me, feels like Tapestry is walking away because they've had enough, and it's too expensive for a stock that's just plummeted.
Yeah, it is really interesting that even though there is all this optimism that we're going to have a more favorable regulatory environment next year, that you're going to see more M&A, that Tapestry just couldn't hold out. Now they're buying back all the bonds as well, and just not the confidence that they could close this deal by February 10th. It's just fascinating.
They have to buy back the bonds at 101 cents on the dollar. I think that's a little interesting, just that baby little premium. The reason I think it's interesting is if they go back at this deal again, interest rates are not seemingly going down that much. Refinancing into a deal market next year might not be as easy as people think.
Well, let's talk about rates, and let's talk about it in the context of the PPI data that we got this morning. For more, let's welcome in Mike McKee. He is our Chief Economics and Policy Correspondent. And Mike, actually, when it comes to the PPI data, I want to go to this note from the BLS that over 1/3 of the rise in the index for final demand services can be traced to prices for portfolio management. Break that down.
This is the pogo trade. We have met the enemy, and he is us. We are seeing so much trading going on that the portfolio management category of PPI final demand goes up 3.6%, a massive increase. And according to the people who calculate all this stuff, that means a big rise in the PCE when we get that at the end of the month, and that's going to worry the Fed a little bit. Now, you take a look at the overall numbers, and I go back to Grant Williams saying things that make you go, Look at the trend here in inflation, both for CPI and PPI. It's telling you that, at least at this point, we have stalled out above the Fed's 2% target. Does that change? That'll have we get another couple of numbers before the next Fed meeting. That'll have a big impact on what they do. And then, of course, jobless claims fall to 217. It shows that the labor market is still very, very loose or tight, rather, and we have pretty strong labor market. You can't see any movement in that line after we get down from the pandemic. It looks at this point like we're still employed and we're still making money and we're still going to be able to spend it. I mentioned the calendar coming up, though, guys. Retail sales tomorrow. We'll see if all that money translates into additional spending. And then we get the PCE numbers at the end of the month. November jobs, December 6th. Another CPI, December 11th. And then the Fed meeting is December 18th. So mark your calendars.
All right. That was a reference to a song from 1991, CNC Music Factory.
I was obviously born by then, but I still don't know what you're talking about.
No.
I was not alive, but it sounds like a great song.
I knew that, yes.
Mike Wilson, you.
That's in my wheelhouse, 1991. Yeah.
That's your time. Hey, Mike McKee, thanks very much for that look at the economy, that setup in terms of inflation. Mike Wilson, welcome to the show. Thanks so much for joining us. Chief U.S. Equity Strategist and Chief Investment Officer of Morgan Stanley. I wonder about your take on these markets in general. Step away from the politics. Step away as much as you can from the economics, and just look at the level on the S&P. I mean, 6,000, and I think your middle of the year target for 2025 is still 5,400. Don't we now, in the face of a second Trump administration, just march higher and higher on stocks as he deregulates and cuts taxes?
Yeah, we had 6350 in our bull case, and we kind of talked about that in the last time we were on the show, and I think the other ones, but that we thought if a Republican sweep occurred, which was the most likely outcome, we could probably trade 6,100 probably before year end. So we're right there. Can we get higher than that in the near term? I think it's going to be hard, but yeah, we're marching higher. I mean, this outcome was unexpected 4 or 5 months ago. And as usual, the market's figured it out, right? So in September, we pivoted more cyclically. We got a little bit more constructive on the index for these reasons. And the animal spirits activity, I mean, goes back to what Mike was saying about CPI, PPI. We had the same problem a year ago where, like, when the economy gets going, you get velocity in the economy. That's the thing that can probably hold us back, is if rates start to back up again on concerns, or starts to interpret maybe the Fed can't cut as aggressively, and then the multiples have to come down. But it'll be a stair step, right? We'll get pullbacks, probably be bought. It's a little euphoric right now. We'll have to have some consolidation.
Mike, we still reach 6,000 with rates relatively high. And when we claw ourselves out of earnings season, have you liked what you've seen so far, such that you could even raise expectations into next year? Where's the risk?
Yeah, well, I think the risk, and we've talked about this, it's not a risk, it's an opportunity, is that it's broadening out now. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy. And that translates into better stock performance for the average stock. So the market's speaking.
Wait, did you see my equal weighted chart?
Exactly. But the market's speaking loudly. The one chart that you probably haven't looked at, which I think is the most kind of bullish confirmation that there's a real change at foot, is that gold now is underperforming the stock market. So for the last year, gold has actually outperformed the stock market. And that to me is a sign that the real returns have been sort of muted. And so in the last week, the S&P divided by the gold ratio has gone up by almost 12%. That's an interesting development to me, and it signals that maybe this political change does have lasting implications for what I've been talking about, is this crowding out of government in the private economy, and the government can be shrunk, which is what they're talking about. Then maybe the private economy can blossom. And that's what the market's trying to sniff out. It's not going to be a smooth ride, so there'll be fits and starts, but that's kind of how we're thinking about it.
A lot to dig into there. We've definitely looked at both of those asset classes, but in isolation. Our producer's working on getting that chart. But let's build on what you're saying, that if the government can shrink, maybe the private economy can blossom. Is that a base case? I mean, do you think that will actually happen and you can invest around that?
Well, I think you have to start thinking about it. I mean, the market's already going there. So the question is, do I want to join what the market's telling me? I think you have to have a foot in that, at least 1 foot in that area. And that's what we did in September. We went to sort of quality cyclicals led by financials. That was the real sector that we got behind. But it also includes things like industrials, some small caps. Like, we haven't gone full in on small mid caps only because rates are still too high. And now with this question mark around inflation again, that's harder for us to get like uniformly bullish on smaller businesses. That doesn't mean that smaller businesses can't do better. It's just going to be more idiosyncratic.
So I feel like, did he say his bull case was 66.50? So does
Could
that
you go
mean
higher?
63.50 was our bull case for May of next year.
But do you want to make that now your base case and give us a new bull case?
Well, we're working on that right now. You'll have to stay tuned because we can't talk about unpublished targets. But look, directionally, the market's already gone there. We've been kind of joining in that call for quite a while now, 3-4 months. And like the more important call, just to be clear, the more important call is not the index. We've said this for a while, is being in the right parts of the market.
True.
And like this year, we've navigated that pretty well, probably I think better than most in terms of being somewhat more defensive in the summer. And we got the growth scares, and then we pivoted more cyclically as an example. That doesn't mean we get everything right, but that's what portfolio managers are really doing now. You got to be in the right places. It's not about just owning S&P. We got to beat the S&P.
I remember when you said that on surveillance in April.
That's right.
Yeah.
That's the game.
Well, stick with us, Mike. Of course, we're going to get to the good stuff next, the politics in the markets. Anyways, we are going to talk about that. But coming up, Gates and Gabbard. We're going to bring you the latest on President-elect Trump's cabinet and what Senator John Thune's leadership means for the Trump agenda. That's up next. This is Bloomberg.
Well, President-elect Donald Trump shocked Washington with his decision to nominate loyalist Matt Gaetz as his attorney general. Former House Speaker Kevin McCarthy, who was toppled by Gaetz last year in a rebellion by ultra-conservatives in the GOP, spoke about the odds of Gaetz's confirmation.
I think choices are very good except one. Look, Gaetz won't get confirmed. Everybody knows that. It's a good.
How are you reading
It's a good deflection from others, but Gaetz couldn't win in a Republican conference, so.
The announcement of that nomination just capped a string of other controversial picks from Trump in the past 24 hours. Joining us now is Bloomberg government reporter Kate Ackley in Washington. And Kate, building off of what we heard from the former House Speaker, the confirmation process, I mean, is that something that you're hearing broadly when people are talking about all of these picks?
Right. I mean, a pick like that is subject to Senate confirmation. All the cabinet level positions are subject to Senate confirmation. And so the question is, how deferential will this incoming Senate Republican majority be to incoming President Trump of the same party? Will they be completely deferential? I think former Speaker McCarthy makes a good point. It may be very hard to get someone like Matt Gaetz confirmed through the Senate. And that's why you've seen some speculation and even President-elect Trump talking about recess appointments as a way to get members of the cabinet installed when the Senate is in recess. That is not necessarily going to be what the Senate allows. And, Senate Republicans yesterday picked their new incoming leader, John Thune. We sort of referred to him in our coverage as the old guard. This is somebody who's been in the Senate 2 decades, more than 2 decades, will be sort of using the rules of the Senate and being that likely the check and balance that the Senate is supposed to be on the executive branch.
Yeah, that check and balance key at a time when, a lot of these nominations, I think Matt Gaetz said he wants to ride or die with Donald Trump. So if the president goes down, he's willing to bring the rest of the country down with him. Is that the same for Tulsi Gabbard, for Pete Hegseth? I mean, are these picks serious? Are they going to go through?
Well, there's speculation that maybe these are, the incoming president picking some loyalists and doing favors for people that have stuck by him, helped him in the campaign, that maybe there will be other picks forthcoming and they will look more palatable to the Senate and the American public by contrast. But he is the president-elect, and there were senators, and I think you've had some on your shows, who have said, he won. He has a mandate. He won, it seems, the popular vote as well as the Electoral College. So how much deference do senators and, other officials give him to pick the people that he wants? That's the question.
Certainly interesting to watch that push-pull between the Senate and the White House. Kate Ackley from Bloomberg Government, we thank you so much for your time today. Mike Wilson of Morgan Stanley still with us. And before the break, you were talking a little bit about what it would mean for the government to become more efficient. That seemed like a little bit of a nod to the Department of Government Efficiency, DOGE.
That's right. I mean, of all the appointments that I've seen so far, that's the one that offers, I think, the most interesting potential upside. Because we knew that President Trump would be tough on immigration, okay? So the appointments there don't surprise anybody. We know that he's going to be tough on tariffs, okay? So that's not new news. What's new news is how serious are they actually about trying to make the government more efficient? You bring a guy like Elon Musk and Vivek Ramaswamy into this program. I mean, these are serious business people. And, you know, so I think that's exciting. It's going to be a tough road. I mean, our House view is it's going to be tough to actually cut spending. Hey, let's start with freezing spending. You know, let's try to you know, small wins here. So that's what I'm really focused on, because from an equity market standpoint, that's the potential for much more upside, not at the index again, but for the average company. If we can get the government sort of out of the hair of the entrepreneurs in America, boy, that's kind of an exciting story, potentially.
Well, Mike, let's go down this road. Let's build that hypothetical path. Let's say that DOGE is successful, that they manage to freeze spending, cut back spending, improve efficiency. What does that mean for the economy, and what does that then mean for the stock market?
Well, that's the tricky part too. Is that this? I mean, look, this is a Herculean task. Okay, it's been tried before, by the way, and it's run into roadblocks. In fact, I think in Trump's first presidency, they tried to go down this path, kind of gave up in the end, and the government continued to expand. So, because it's exhausting. So it's going to take time, and the path from here to there probably means slower growth in the short term, right? If you shrink the biggest growth driver in the government, what does that do to the overall economy in the short term? So there's a lot of unanswered questions. We have no details, as usual, at the beginning here. But once again, this is an area where we're very focused on, and we're going to have to key off headline announcements, and then we're going to see what they can actually get done, whether it's the first half of the year, second half of the year, how long it takes to play out. So a lot of unanswered questions, but to me, this is the potential for a big surprise where we have to be open-minded to.
I mean, the question is, which we won't answer here or this year or next year, does Donald Trump care about his long-term legacy enough to risk his shorter-term reputation? I was looking at a chart that our producer in London, Daniel Curtis, gave us this morning, showing that stock and bond yields have hit parity. And I was thinking, you know, with the policy uncertainty, do you go into Trump 2.0 with a stock portfolio, or is it safer to bet on bonds?
Well, going into the election, we felt like this is the outcome, that basically if Trump won in the Republican sweep, that stocks would do better than bonds, and that's basically played out through the fall. So the question is that fully priced now? In the short term, it probably is priced, meaning we got the easy part of that trade is kind of behind us, and now it goes to the stock level. And clients that we speak to are in the same boat. So initially what they do is they buy futures because I don't really know what to do exactly. And now what they're doing is they're just topping off existing positions. So if you look at crowded positions, they've continued to do well. It's like continued momentum on that trade. But then as we get into December, people will start thinking about next year. And that's where we take a break. We'll take a break, and then we'll have a new theme, a new idea to it's totally away from politics, right? The market needs a new idea, a new theme to gravitate to, which, by the way, is one of the reasons why we're seeing some of these crazy moves in speculative areas, right? People are making money in crypto, as an example, and then they're funneling it into like the next hot story they're hearing about on the internet, or they're from their best friend or whatever. That's a little frenzied at the moment.
Well, when we think about the stories of next year, you think a lot about taxes, and the debt to GDP ratio today is not the same as it was back in 2016. The tax cuts, or at least the extension of the 2017 tax proposals here, do you think that now that we have a red sweep, is just a sure thing, or is there some discipline there to keep some of that from rolling off?
Yeah, and do they lift the SALT cap and make it retroactive very early next year?
Well, the retroactive isn't happening, and I wish. But what I would say is, I think you're totally right. We've written about this too. This is not 2016. We don't have the slack in the balance sheet or in the economy itself, in the labor markets, particularly if we're going to reduce immigration and deport some of the folks that are here. We don't have that slack. So if they try to really push the envelope on increasing spending and reflating, inflation is going to become a problem really quickly. So they have to be careful about balancing. Okay, we're doing some cost cutting. That's great. Maybe then they could cut taxes a little bit, but I think you have to do more. Like I would freeze taxes. I would maybe extend the TCJA and then call it quits. But I'm not in government. But I think that the markets will respond much better to fiscal discipline on both sides, both taxes and spending, as well as entrepreneurially favorable policies.
Well, the good news is that you can tweet at Elon Musk. He's welcomed suggestions coming online. Mike Wilson, it is always a treat to speak with you. That is Mike Wilson, of course, of Morgan Stanley. Now, coming up later today, JPMorgan CEO Jamie Dimon speaks with Bloomberg's Lisa Abramowitz from the APEC CEO Summit in Peru. You can catch that conversation at 2:30 p.m. Eastern. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's take a quick check on futures right now. 5 minutes until those bells ring. It's pretty quiet, but to the downside. The S&P 500 slightly lower so far. You can see that big tech, more of a direction there. That was the setup yesterday. This is basically how we closed yesterday afternoon, and we're holding that in the pre-market. The NASDAQ 100 down about 0.2%. The Russell 2000 also declining yesterday, up a little bit pre-market on the Russell 2000, currently higher by about 0.2%. And it was interesting in the conversation with Mike Wilson. Sounds like he's pretty neutral on small caps versus the rest of the market there. And then I think back to your equal weight chart. I mean, it has been interesting, the outperformance at the size level when it comes to the small and the equal weight, but how sustainable that is, I think that's where people start to waver. Yeah, and I also didn't realize, I was just last night reading a story from this summer when equal weight, hit a new record high. So I didn't realize we'd seen that huge divergence, but maybe we see a rotation trade again. There are a lot of investors who want it, right? Steve Whiting at Citigroup was pitching S&P 400 as well, but let's see where it goes. At the end of the day, the S&P 500 has still sustained in and around 6,000 for a while. Anyways, less than 4 minutes to the opening bell. We'll discuss the market moves with Steve Chiavarone, Federated Hermes, head of multi-asset. This is Bloomberg. We are moments away from the start of trading on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. Not a lot of movement in terms of futures. After the S&P came up through that 6,000 mark, we haven't really moved far off it, as Sonali was just saying. Right now, unchanged on futures. NASDAQ futures down 1/10. Russell futures up about 1/3. You hear the opening bells, and on the New York Stock Exchange, you have Veris Residential celebrating its 30th year of listing. In those 30 years, they have underperformed the Bloomberg REIT Index by 1,000%. Over on the NASDAQ, BeyondTech is ringing the opening bell to celebrate its 5-year anniversary of listing on the NASDAQ. In those 5 years, they have sextupled their stock, more than tripling the gains on the NASDAQ. So they've done a little bit better. Katie, what do you see in terms of the averages? Yeah, story of have and have-nots there, but everyone's clapping all the same. You take a look at this market right now, not too much to get excited and clap about. You have the S&P 500 a little bit higher in the first few seconds of trading to the tune of about 0.1%. The same thing if you take a look at your big tech index in the NASDAQ 100, higher by about 0.1%. Small caps outperforming once again. You can see the Russell 2000 currently higher by about 0.4%. This was your underperformer yesterday. It's been really hot and cold, but over the past month, it's been all small caps. Now, taking a look under the surface, a really fascinating story here. Capri and Tapestry showing big moves after walking away from their $8.5 billion planned merger. A U.S. court had frozen the deal due to antitrust regulators' objections, and now you're seeing, of course, it just fall apart completely. Interesting, Capri going down a little bit, but Tapestry higher to the tune of about 8%, Sonali. Katie, I'm just keeping an eye over here on Meta because it was fined $841 million by EU regulators for antitrust violations related to its Facebook marketplace service, and you're now seeing Meta down about 0.7%. It's been fluctuating between 0.6 and 0.8, Matt. Yeah, Meta Platforms is interesting. A lot of individual movers that are catching our eye today. Advanced Auto, for example, erasing its pre-market decline after results missed estimates.
it did announce plans to close about 500 stores and cut jobs. And typically markets appreciate it when you do that. There are obviously different individual circumstances, but in this case, Advanced Auto up 10% at the open. Another stock we're watching, and this to me is one of the most interesting stories on the day. Disney didn't just beat expectations on profit and sales in its fiscal fourth quarter because it had big movie hits like Deadpool and Wolverine.
My favorite.
Inside Out 2.
Inside Out 2, which I still have not, well, I have not seen either one, but I thought it was amazing. Disney forecast profit gains going out 3 years. And they don't typically give long-term outlooks. So they're saying double-digit profit growth in 2026 and 2027. As a result, the shares are up the most since February. And we're joined by Geetha Ranganathan of Bloomberg Intelligence to talk about this. So what is the deal with Bob Iger, Geetha, going out on a limb here and promising something in 2027 to shareholders today?
Yeah, absolutely, Matt. I mean, the empire strikes back, right? Really big time. And it's really been, the biggest gripe, I think, for Disney investors has kind of been this lack of clarity around some of the businesses. There's been this theme park softness. We know that streaming has finally turned a corner, but we really didn't have much visibility in how those profits, how those margins were going to pan out. Remember, they do have to chase Netflix there, which is the leader with, over $10 billion in profit. And then you have the movie turnaround, which has again been in progress, but them laying out things for us so clearly, line item by line item, really inspires a lot of confidence.
Speaking of confidence, want to touch on streaming just a little more there, because what's fascinating to me is, yes, they may have to catch up to Netflix in a larger way, but we have seen many enter this world and fail. So is there a moat that they can create in certain businesses, given they both have Hulu and ESPN, which has the holy grail of sports?
Oh, absolutely. I mean, we've seen them already kind of do that in a way, Sonali, with Disney Plus. Remember, they have, the studio, the performance of the studio is so important, not just for theatrical and box office numbers. And remember, they've generated $3 billion at the box office just from Inside Out 2 and Deadpool. But it's those movies coming to the streaming service that again kind of sparks those subscriber numbers, and we have a really stellar slate kind of lined up both in fiscal 2025 and 2026, and that's going to keep that streaming momentum going. So yes, you do have a business here with a lot of scale. Remember, ESPN Plus is also profitable. I mean, all of the businesses now are profitable on the streaming side, and then with ESPN, really the big thing that we're watching is the launch of a standalone streaming product in 2025. And again, they are hoping that that kind of really boosts, streaming profitability over time as well.
Well, anyway, you slice it, a needed shot in the arm for Disney stock, now up 25% year to date with today's jump. Geetha, really appreciate your time. That is Geetha Ranganathan of Bloomberg Intelligence. And later this afternoon, Disney CFO Hugh Johnston will speak to Bloomberg about the company's strong quarter. You don't want to miss that one, but keep it here because right now we're going to broaden out this conversation with Steve Chiavarone. He is Federated Hermes head of multi-asset solutions. And Steve, I want to bring you some breaking news. This from Crane showing that U.S. money market assets surpassed $7 trillion for the first time. ICI data isn't too far behind. And you marry the fact that there is so much money sitting in money market funds, and you have a market that's pretty much at all-time highs. How does it make sense?
So we have insight on this. Federated Hermes, we're a leader in the money market business. And what you see is a lot of those money market assets are not necessarily investable assets. This isn't cash that's going to be put into stocks or bonds. What you've seen and what you're continuing to see is that money markets in many cases offer better yields, a little longer duration, and a much better deal than traditional bank deposits. So you're seeing this money that's been in bank deposits. When rates were zero, it could sit there because it didn't matter. Well, now, rather than getting 0% in a bank deposit, you can still get a high 4% yield in money markets, and that's really attractive. And we think that's going to be attractive for some time. So it's a different pool of money. That's really cash. What you see on the equity side, I think, is we're seeing a rotation from the dominance of big tech and large cap growth, and we're starting to see other parts of the market perform, particularly small caps.
Obviously, money markets are a different thing than just straight treasuries, but I saw a chart this morning showing that stocks and bond yields are now at parity, and I was thinking, which is the better bet going into Donald Trump 2025? Do you want to own stocks at a time when he's likely to deregulate and cut taxes, or do you want to own bonds at a time when he could put on tariffs and do mass deportations? How do you think about that trade?
I think you want to own stocks. I think that if you look at the sum total of his policy set, and you're optimistic, it's pro-growth. If you're pessimistic, it's inflationary. I think it's probably a little bit of both. I think it certainly is pro-growth. I think lower taxes are pro-growth. I think deregulation is pro-growth. Tariffs can be inflationary if they're implemented, if they're used as a threat to encourage re-onshoring. That can also be pro-growth. But one way or another, it looks, and the market has priced in the last week and a half, that a Trump presidency is bond unfriendly. We've seen 10-year yields back up, and we think they'll get above 4.5%. But it's equity friendly, and it's particularly friendly for cyclicals, companies that are U.S. focused, and small caps, which are both cyclical and U.S. focused. And remember, small caps have to comply with 100% of the regulation with only 10% of the revenue. So on a dollar for dollar basis, they really benefit from deregulation. So we think it's clearly a stock story.
Speak more to that. Matt made out this great point a little earlier that if you invested in the S&P equal weight, you're really lagging as of late when you compare it to the S&P 500. It's not true for the Russell 2000. You're seeing a lot more love there. And the Russell 2000 is actually outperforming since the beginning of November, even the NASDAQ 100. So how much money do you put to work chasing that trade?
So across our multi-asset portfolios, our two biggest active weights are an overweight to small cap and an overweight to cyclicals. When you think about that equal weighted S&P 500, remember, you have growth stocks, but then you have value, which is really two communities of stocks, right? There's your cyclicals, which are economically sensitive, which do well in a higher rate, higher growth environment. And then there's your more defensive dividend payers that generally don't do as well when you've got a 10-year yield moving up as much as it has. And so, to just be as simple as to say, well, I'm going to own the equal weight versus the market cap weight, we think you got to be more specific. You need to do some stock selection. And so when we look out, we look at parts of the market that are not at all-time highs, that are not trading at kind of really stretched valuations, and that have earnings growth that's inflecting higher. And you see that in small cap, both growth and value. You see it in financials, you see it in energy, you see it in parts of industrials, you see it in parts of materials, you see it in consumer names, not named Amazon. And that's where we're allocating capital. And if you look, that has been working over the course of the last few weeks.
Steve, really quickly here, I want to finish on small caps and talk about whether or not there's a FOMO trade going on, because Bloomberg Intelligence has some really great data that if you take a look at pure play small cap managers, a lot of them own mid caps. A lot of them own those larger names. They've been cheating up to juice their returns, so to speak. Now that we have small caps outperforming, a lot of people expect that will be a sustainable path forward. Do you think that we could see a lot of managers come back into small caps in a big way?
I think you can and you will. And I think this demonstrates the importance for clients out there to choose strategies that are style pure, that deliver what they're designed to deliver. Whether it's rates falling, that helps small caps. A steeper yield curve where you're seeing short rates fall but long rates stay high, that's good for small caps because most of their debt is floating rate debt based on shorter term rates. Earnings growth, they're going from negative 16% earnings growth this year to positive 40 next year, and they're 2 standard deviations cheaper than they normally are. So for a lot of reasons, we think that this trade has legs, and we think if you want small caps, then you need to own actual small caps.
That's what Katie wanted to hear.
Yeah, all right.
We love the small caps here. Perfect. All right, Steve, thanks so much for joining us. Steve Chiavarone there of Federated Hermes. Coming up, we're going to talk about the collapse of the Tapestry Capri deal. It was an $8.5 billion acquisition. More on why it's not going to happen next. This is Bloomberg.
This is Bloomberg Open Interest. A quick check on stocks because we've turned lower in the first few minutes of trading. The S&P 500, the NASDAQ 100 now down 2 to 0.3%. Even your mighty small caps falling prey here. You can see the Russell 2000 down about 0.1%. We'll keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Barclays upgrading American Air to equal weight with a $16 price target. The analyst is expecting improving fundamentals and investor sentiment to drive a powerful rally for airline stocks next year. Next up, UBS raising its price target on Abercrombie & Fitch to $170 and maintaining its neutral rating. The analyst says that the brand's fundamentals remain solid. And finally, HSBC raising its price target on NVIDIA to a joint street high of $200. The analyst says that he still sees more AI-driven growth in store, Matt.
Yeah.
All right.
AI-driven growth is definitely coming.
Yeah, especially for NVIDIA.
And especially for those guys. Now, let's talk about Capri and Tapestry. I was trying to think of a segue, but I can't get from
No, that was okay.
artificial intelligence to mall-grade handbags. They have decided to mutually end their $8.5 billion merger. Of course, there's no such thing as a merger. It was an acquisition, right? Tapestry was going to buy Capri, and then Donald Trump won, tariffs are coming, the FTC said no way, and Capri stock was off 60%. Let's talk more about this with our deals reporter, Crystal C. She joins us here on set. So there's so many reasons that this ended up looking like a bad deal for Tapestry, and they're out.
Well, the FTC said no before Donald Trump came in.
Right, true. I should have said that was like earlier this year, and then they pushed out until February?
So a month ago, the FTC said no, but all along people had been saying that it's a very tough deal to get done. You probably wouldn't think that, and I didn't think that. Affordable luxury, like handbag, barrier of entry is pretty low, and it's a pretty controversial decision. And when
but Lina Khan wants to make sure there's competition in this handbag market, right?
There needs to be competition everywhere in the market, but
kind of get lucky. I mean, I hate to say that, but if you look at it, Tapestry just raised their outlook. They're doing pretty well. Capri's going to have some trouble. It looks like they have to cut their fleet of Michael Kors stores. And so look at the price of Capri now. I mean, it's meaningfully lower, as you were mentioning to us earlier. Is this a deal that maybe shouldn't have happened anyways?
The deal price was at 57. Yesterday at close, Capri was trading at 18. It's been a really tough couple of weeks since the FTC decision came down. The stock have significantly dropped, but like you said, like, is it in hindsight a good thing? You have to bear in mind also that if you're in a merger talk, an acquisition talk, no such thing as a merger, as you say, you're probably putting a lot of things on hold. You're not thinking about improving your business, doing your marketing channel, and this is probably a good moment for all of that to come back leading up to the holiday season. Maybe they wouldn't catch this season, the next season. So this is, the company will have a call this morning at 11 to talk through their strategy, but now that they have to be an independent company, at least for now, they will have a lot of those, the strategies and like the improvement coming.
Yeah, definitely a call to listen into. And it's certainly telling that Tapestry shares are much higher this morning. What happens to Capri, though? Do they try to shop themselves out here? Can they survive without being bought?
So everybody who wanted to look at this brand would have looked at this brand throughout this 18-month ordeal of Tapestry trying to buy this company, not happening, all of that, right? So likely that you already smoked out the people, but then the price is key here. It's significantly a smaller price, so you could see people coming in and looking at it. And is it currently more vulnerable than it was 18 months ago? I think so.
It's a deal. It's a sale.
It's on sale for sure. Crystal, thanks so much for joining us. Crystal C. from our deals team at Bloomberg News. I'm sure we'll continue to talk about the breakups into the M&A boom. Coming up, Polymarket is catching the attention of the FBI and the DOJ. We'll take a look next in our Wall Street beat. What's going on with the crypto betting site? This is Bloomberg.
Welcome back to Bloomberg Open Interest. You're taking a look at stocks on the back foot right now. The S&P 500, the NASDAQ 100 a bit lower this morning. A drop in Tesla dragging down both indexes, currently off about 1.4%. It's a big company, though, and it's a big weight right now. The Russell 2000 also down a little bit, though. Small moves overall. Small caps down about 0.1%, Sonali.
And Katie, it's time now for the Wall Street Beat. Today we are looking at crypto predictions betting platform Polymarket. It is under investigation by the Department of Justice for allegedly violating its agreement with the Commodity Futures Trading Commission. Joining us with more is Bloomberg's Charlie Wells. And to put this all into context here, Polymarket, of course, has become very, very, very popular lately because of the predictions made into this election cycle. But of course, since 2022, since their agreement with the CFTC, it is to be that U.S. users cannot use it onshore. So what's going on? Put this all into context here.
Sonali, I'm just going to go out there and say this, and basically prediction markets in the United States are in sort of a puberty phase. So they're growing a lot, as you say, they're developing, but they're also going through some sort of awkward phases. And I think counting in that awkwardness is, a dawn raid by the FBI on the CEO of Polymarket. And as you say, a person familiar with the matter says that the company allegedly allowed U.S. users to trade on this market. That would be a violation of that 2022 deal that they struck with the CFTC. But it's a little bit confusing, right? Because there are other markets that are, taking off in the United States. We've got Kalshi as well. And, Kalshi, they allow election betting. And so according to a recent federal court ruling, election betting is allowed in the United States, but you have to be registered with the CFTC. Now that brings us back to Polymarket. Of course, they are not registered. They have that deal with the CFTC, but they do not have the same type of agreement. And the real rub here, I think the interesting thing, if you're looking across all of these different platforms and you want to know why there was that dawn raid on Polymarket, something that's really interesting is that U.S. financial regulations do not allow betting on things like wars, even on things like sports. So that's under financial regulations. So you can do that on Polymarket, but you can't do that on platforms like Kalshi.
So I know that the head of Polymarket said something like new phone, who dis?
That's exactly it.
Which is like, I'm practically a boomer because I love that. But what is Polymarket's actual response to this? Because they've dealt with this before. They knew this was an issue and they took steps to address it.
It feels like really good marketing for this company, to be completely frank. But look, they have said that they are going to defend themselves. They're going to defend their community. The company also said that they felt like this was politically motivated, right? We need to remember that just last week, it was the Republicans who did have that solid sweep in the election who were touting the likes of Polymarket, saying, of course, that they were more accurate than polls, and they ended up being that way. So you get this kind of defensive posturing. You say they're going to stick up for their community. And of course, you get the CEO now front and center posting kind of funny things on X.
All right, Charlie Wells, 30 seconds. What happens next? Where does this go?
Look, I'm going to take it back to that puberty phase comment I meant. I mean, look, these markets are growing. They have a sort of air right now of invincibility. In large measure, they beat polls in the last elections. So, you pair that as well with this rally that we're seeing in cryptocurrencies. On Polymarket, of course, you've got to bet with cryptocurrencies. You pair predictive markets with cryptocurrencies with the incoming administration, which embraced both of those things. And it seems like a positive direction for travel, but maybe some legal challenges along that route.
All right, Charlie, thanks so much for joining us. Charlie Wells there talking to us about Polymarket. I think new phone who dis is what I text the most often.
I've never gotten that text, just saying.
What?
But
Sometimes, hey girl, you up?
please don't text me that ever.
No, I just don't answer text. So.
Markets are not up right now. We've seen kind of a little bit of a crescendo, and they've been turning down. So we're going to keep you up to date on that. Still at a, obviously, relatively high level after crossing 6,000 this week on the S&P. We're going to talk about Brooks running shoes as well. And this is very cool because Brooks has a partnership with Disney that
just announced.
I just found out about it. So stay with us for that CEO interview. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, stocks are struggling to make headway following fresh economic data this morning and more earnings rolling in.
Trump's growing cabinet, the president-elect's latest picks reflect his emphasis on loyalty and TV. I guess skills would be one word you could use, as well as some sort of sensibilities.
Well, we'll talk about that. We're also going to talk about running. I am so excited for this conversation. The CEO of Brooks is joining us. That's after the footwear brand passes a milestone $1 billion revenue. We'll speak to the CEO, Dan Sheridan, in about 30 minutes. Before we get there, let's get a check on these markets. You can see we're just a hair below 6,000 on the S&P 500. Of course, down about 0.1%. Not too much, but still, the color is red. It's a little bit more red if you take a look at the NASDAQ 100, down about 0.3%. I will note volume pretty light today. It feels like maybe we're all just taking a little bit of a break. Then you take a look at the bond market. A bit of a rally. We're down 3 basis points on the 10-year yield, but these yield levels are so elevated, 4.41% on that 10-year Treasury yield, Matt. It has just been a rapid rise over the past couple months.
Yeah, it's Thirsty Thursday.
Oh.
You know, I think people just need a drink. It's been a week.
Yeah, I'm tired, man.
It's been a long 7-day period, and there's been so much packed in.
Remember when you said
there.
last week went by so quick?
It did. It flew by, but it was still a lot of things happened.
Yeah.
You know, and do you not get the feeling that it's going quickly?
I feel like every day lately is a full month. But
Yeah. All right. Well, a month ago, we spoke with Morgan Stanley's Mike Wilson. Actually, it was like 45 minutes ago. He says investors should be watching signals from the gold market.
The one chart that you probably haven't looked at, which I think is the most kind of bullish confirmation that there's a real change at foot, is that gold now is underperforming the stock market. So for the last year, gold has actually outperformed the stock market, and that to me is a sign that the real returns have been sort of muted.
Joining us now to talk more about this, Sitara, Sundar, JPMorgan Private Bank Global Equity Strategist. Welcome to the program. Thanks so much for joining us. I think part of Mike's point was that stocks have been on an absolute tear, right? Surprising almost everybody. The median strategist estimate is where we are now for a year end. What do you think? Are you raising your S&P target?
Yeah, so I think, first, thank you so much for having me. I love being on this show. I think, look, there's a confluence of things that we need to think about when we think about equity markets. One, we just came off of a pretty solid, maybe unspectacular earnings season, but a solid earnings season where going into earnings season, the street was expecting 5% growth, and we're actually surpassing that. And we think it's going to end up closer to 7 or 8%. So I think one thing to think about is earnings continue to be strong, and our expectations, look, there might be volatility heading into year end. We think we'll be in a range-bound market heading into year end, but we actually raised our target for next year, and we're expecting the S&P to reach 6,400 by the end of next year. Now, the biggest thing that I always like to mention is what is driving that. Is that valuations or is that earnings growth? And what makes us comfortable with that target, and even after the heroic rally that we've seen in the S&P 500, not just this year, but really over the past 2 years, right, is that we still expect to see above trend earnings growth next year. Low double digits, call it around 11% year-over-year earnings growth. And that's not going to just be driven by tech, which I also think is a big point.
6,400 is only 6% higher than where we are right now. So, I mean, the pace of growth, that implies a meaningfully slower pace of growth in the S&P 500. Is there a better place to invest outside of the S&P 500 to get a better return on a percentage basis?
Look, it's the number one question that everybody is asking. We've seen U.S. exceptionalism over the past couple of years. Do we think that's going to change? And honestly, the answer is no. We still think that the S&P 500 and U.S. large cap is the place to be. We've seen a couple of things, right? We're in an easing cycle in the Fed in terms of the moves that we've seen over the past couple of months. Two, we now have certainty from an election standpoint, and we have a Republican administration and a Republican sweep. Now, historically, that has been pro-business and pro-growth. So from expectation on the broadening of the earnings rally that we expect to see, we think that's going to be supported by a broadening in economic activity as well. And then the last thing that I'll mention is that there's a difference between headline and under the hood. So yes, the S&P 500 has rallied meaningfully over the past couple of years, but 55% of those returns have come from mega cap tech. And that's where the earnings have been. But moving forward, when we look under the hood, yes, that headline 6% return, and you look at that versus fixed income, maybe it doesn't feel as exciting. However, when we look under the hood, industrials is an area that we see even a sector that we think is going to outpace the S&P 500. And the second part of that is even within technology, we've seen a meaningful rally so far this year, but a majority of those returns have been semiconductors. So we actually think that rally is going to broaden. And so the opportunities moving forward also will be within software. And we started to see that over the past couple of weeks.
Interesting. So a rally within tech, a broadening in tech.
Yes.
I actually want to rewind, though, and go just to the end of this year before we talk more about next year, because it sounds like you're expecting a sideways chop, so to speak. And the stat I keep coming back to is the fact that we're seeing 20% plus gains on the S&P 500 back-to-back years. We haven't seen that since the 90s. So when it comes to just the next couple months, are you saying because we've come so far, it makes sense that we pause a little bit here?
I think that it makes sense that we pause. We've seen a meaningful rally so far this year, but again, I will always come back to the point that headline is very different than what we're going to see under the hood. We have seen, even if in terms of expecting a more range-bound market moving forward, there will be volatility and there will be dispersion, and therefore there will be opportunities for investors, even if the headline markets are a little bit more range-bound. And what we've been telling clients to do is invest in those areas of the market where there are three things. You have durable earnings growth, you have reasonable valuations, and given the rotation that we've seen within market, there are a lot of these high quality companies that are trading at a discount to where we think that they should be. So even now, if we're talking about putting money to work, high quality industrials is where we think clients should be putting money to work. It's our preferred sector within the S&P 500, not just through year end, but into next year as well. Because again, as we have certainty around the election outcome, the amount of money that we see from a fiscal spending perspective within revitalizing the industrial complex within the United States, we have a little bit more certainty around that. And historically, what we've seen on a year-over-year basis is CapEx actually inflects higher once we get certainty after an election outcome, as CEOs feel a little bit more confident. So when we see that spur in spending, it's a confluence of factors that even into year end and next year, that's where we see the opportunity.
Is it still, though, Sitara, you know, I've been asking a lot of people about bond yield and stocks yield parity today because I wonder, or I say, I wonder what you would buy going into a Trump administration. I know it's stocks, right? Because it's better for stocks and because we're worried that yields are going to go way higher, especially if you get these tariffs and deportations and inflation. But if yields are higher, and they're already pretty high now, isn't that bad for small cap stocks? Isn't that bad for the Russell? Isn't that bad for a lot of specific industries?
So it's a good question. I think within the small cap universe, half of that index, if you look at it passively, is in unprofitable companies. So if you enter an environment where long end rates end up being a little bit higher than what the market is even pricing in at this point in time, it couldn't be difficult for some of those areas, which is why we prefer large cap over small cap at this point in time. However, the biggest thing to remind ourselves is over the long run, earnings growth is what is going to end up driving stock prices. We will see fits and starts over the next few months as rates start to normalize and we figure out what that terminal rate is actually going to end up becoming. However, earnings growth is what's going to drive stock prices. So even within the small cap universe, there are these high quality companies that are profitable, that we're likely going to see an inflection higher in small cap business optimism as earnings growth and economic growth at the end of the day ends up still being above potential. And that is what's going to drive a cohort of that area. But that's usually an area that we recommend active versus passive exposure, because the majority of that index is unprofitable and it's going to be give and take, whereas active managers are able to seek out those opportunities.
And, you know, we are seeing so much money flow into that Russell 2000. Will be interesting to see where this trade goes. Sitara Sundar of JPMorgan Private Bank, we thank you so much for joining us on set. We love having you here, too. Let's get a look at stocks moving under the hood this hour. We're going to bring in Bloomberg's Abigail Doolittle.
Well, the big stock moving and the stock story of the day, Sonali, take a look at the shares of Disney right now, up 9.2%. 4%. This after they put up a solid beat on the top and bottom line. But it's really the outlook, the earnings growth for the current quarter of high single digit. The estimate on the street had been 4%, so a big beat there. In addition, Bloomberg Intelligence saying that the park concerns that had been there no longer an issue while streaming was strong. Taking a look at the shares of SMCI, Supermicrocomputer, not so much. Well, actually, Meta Platform down about 0.4% right now. Not a big loss there. Supermicrocomputer, on the other hand, down in a big way as they continue to struggle, and a possible delisting is ahead on another filing that has not been placed. And then on a deal scrapped between Tapestry and Capri, we can see the Tapestry up 11.5%. Capri is down. This is after the FTC successfully managed to have a federal judge block this potential deal. Capri, some analysts are saying that they may have to sell off some of their brand. Of course, some of those brands, Versace, Jimmy Choo, but Tapestry investors, Katie, clearly pretty relieved.
Yeah, not too sad to see this deal go to the wayside. Abigail Doolittle, thank you so much. Now, coming up, from Gates to Gabbard, we'll bring you the latest on Trump's unconventional cabinet picks. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. ASML upholds its upbeat 2030 forecast. The Dutch maker of chip equipment is betting on AI-driven boom to continue in chip demand. That's despite a significant miss in order intakes in the third quarter. And by the way, it's a 2030 forecast. That's a little bit nuts. The board of Ben & Jerry's has accused its parent company, Unilever, of silencing it on advocating for Palestinian rights. The ice cream makers board says Unilever is breaking an agreement to allow Ben & Jerry's to set its own social mission. Ben & Jerry's has publicly called for a ceasefire in Gaza. And rents in Manhattan have hit their highest level in 3 months after climbing in October. A surge in borrowing costs pushed the average rent to levels normally seen during the busier months. Analysts don't expect those rents to come down from here.
We're going to move from Manhattan to Washington. President-elect Donald Trump shocked Washington with his decision to nominate loyalist Matt Gaetz as his attorney general. Former House Speaker Kevin McCarthy, who was toppled by Gaetz last year in a rebellion by ultra-conservatives in the GOP, spoke about the odds of Gaetz' confirmation.
I think choices are very good except one. Look, Gaetz won't get confirmed. Everybody knows that. It's a good. How are you reading it? It's a good deflection from others, but Gaetz couldn't win in a Republican conference, so.
The announcement of Gaetz' nomination capped a string of other controversial picks from Trump in the past 24 hours. Joining us now, Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance, Matt Gaetz. I mean, you know, despite even just the House inquiry here, how is the fallout being really captured in Washington on the heels of this announcement?
Well, I think you just look to the Wall Street Journal editorial board this morning, which starts with, this is a bad choice that would undermine confidence in the law. And I think most conservative senators, Republican senators, would look to the Wall Street Journal editorial board and agree. Many of them walking around yesterday on Capitol Hill saying they were shocked about this. But we should take a step back. I think they would like us to be talking about this idea of Trump tapping Matt Gaetz to be attorney general. Matt Gaetz resigned last night. And while maybe they want you to think it's because he's going to go prepare for his Senate confirmation hearing to be attorney general, what we do know from Punchbowl News is that this Friday, the House Ethics Committee was going to vote on making a very damaging report potentially public that would incriminate him. And not very nice things said about him. What we know from this report is in September, the House Ethics Committee said they were looking into whether or not he engaged in sexual misconduct, illicit drug use, sought to obstruct government investigation of his conduct, and also some questions about some of the gifts he was accepting. So if we think potentially this individual has a path, I'm not sure what that path is going to look like when already you have Senator Dick Durbin coming out in the last 45 minutes saying everything the House Ethics Committee has we are going to need. And those senators could subpoena the House Ethics Committee and get those documents.
We'll fold this into the fact that we now have a new incoming Senate Majority Leader, John Thune. He's been sort of presented as the old guard of the Republican Party. We heard from Kevin McCarthy saying there's no way that the Senate is going to let this fly. How does the new leadership sort of factor in here?
Well, potentially the new leadership is going to be a guardrail or a check on maybe some of what President-elect Donald Trump would like to see done in Congress. He is an institutionalist to the core. He was the #2 under Mitch McConnell. Also, him and Trump have had some confrontations in the past. This was someone where in 2022, when he was up for re-election, Trump wanted him to be primaried and called him a rhino, a Republican in name only. So this is someone who is definitely on the other side, say, of the MAGA wing of the party.
So, I mean, my question is then, would he allow recess appointments, Thune, and is that a way that Trump gets through? I'm confused why McCarthy said the other picks were good. I mean, is Pete Hegseth, a Fox News host, really a good pick to run our entire defense industry, our military? Is Tulsi Gabbard really a good pick to be the director of national intelligence?
I think it depends who within the Republican Party you ask on whether or not these are good picks or not. When it comes to the DOD, does Pete Hegseth have the veteran background doing tours in Iraq, Afghanistan, Guantanamo Bay, Cuba?
Are generals going to listen to this captain who's a TV guy?
Well, the job historically should be civilian. The past few decades, we have had generals. It's not supposed to be. Biden got a waiver to get Lloyd Austin because he was only 4 years out of retirement. You're supposed to have a 7-year gap. Trump got a waiver for General Mattis. We had President Eisenhower tap the head of GM to run the DOD, Engine Charlie. The issue with this individual is he has no managerial experience, and this is one of the biggest bureaucracies in the world with a budget north of $800 billion. So I think when you ask people if he has the managerial experience in Washington, D.C., they're going to say no, especially some of these hawks that want to set deterrence on the world stage.
But does McCarthy think he's a good pick, or is McCarthy just not really thinking about Hegseth and Gabbard because they're not going to be confirmed anyway?
Anne-Marie, is some of this just posturing from the Trump administration as they start to negotiate with Congress?
Potentially. Mostly you have presidents come in a more traditional way and say, this is my pick, I want them to be confirmed. We should also note, you're hearing, can we get these people through? To this day, we still have not been able to get Congress to confirm the acting labor secretary, Julie Su.
Right.
So when you start throwing out all these names, and confirmations hearings can be very hard. The only one really on the board that's going to have a foolproof, easy confirmation hearing is going to be Senator Marco Rubio. And that's been welcomed and cheered along on bipartisan basis. When it comes to someone like Tulsi Gabbard, again, she's an isolationist within the Republican Party. Someone who already the Russian media saying our girl Tulsi is going to be on the in. Someone who has spoke that the fact that Syria's President Bashar al-Assad is not an enemy of the United States and went and met him. She views enemies and adversaries similar to Donald Trump does. An enemy, urgent individuals that need to be destroyed, adversaries, people potentially you can do deals with. Is this someone, though, the very conservative, hawkish members of the Republican Party are going to want to see through? It's going to be difficult. There's only right now 53 seats, and no Democrats are going to line up for that pick.
All right, Anne-Marie, we have less than a minute left with you. We've gotten a lot of picks. Let's talk about what we haven't gotten.
Treasury Secretary.
When are we going to get it?
It's an interesting one that everyone is waiting on. And the Wall Street Journal has a report today that Howard Lutnick, I call him the producer, he's co-head of the transition. Now he wants to be the star. He himself put his name in the ring, according to the Wall Street Journal. The other main contender is Scott Bessent, which a lot of individuals in the Trump world are really lining up behind. He's been working with the Trump campaign over the course of the last few years, last few months, even traveling with the president recently. So we'll have to see. But that is the next name everyone wants to hear drops. Because once we know about the Treasury Secretary, then we can find out maybe who's running the SEC, who's going to run the FTC, and who's going to be the director of the National Economic Council.
All things that people who watch Bloomberg TV care deeply about.
Yeah, but I think Bessent's too safe. Given what Trump has been doing over the last 24 hours, I feel like he's got to pick Lutnick.
Well, I think Trump understands that financial markets care about two picks out of all of these. And it's Secretary of State, and he went for a conventional thinker in Marco Rubio that the markets liked and Washington liked. And he might want to do that as well with the financial markets. There's one thing that does regulate Donald Trump, and Jonathan Farrell says this all the time, and it's the Dow Jones Industrial Average.
Wow. I think that's a diss from Farrow, because he feels the same way about the Dow as you do, Katie.
That's funny. I guess he's not, Trump isn't watching the small caps.
All right, Anne-Marie, great having you on. I hope you can come over here more often.
Whenever you want.
Well, leave your surveillance chair and come join us. Bloomberg's chief political correspondent and co-host of Surveillance with John Farrow, Anne-Marie Jordan. Still ahead, leadership changes at LVMH. We got the latest on succession talks at the luxury giant next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, LVMH appointed new divisional leaders, including the return of one of CEO Bernard Arnault's sons to the Paris headquarters. Alexandre Arnault will serve as deputy chief of the company's wines and spirits division, leaving his New York-based position at Tiffany's. That reshuffle, of course, is fueling succession talk. Next up, Palantir defying Wall Street skepticism. Shares in the AI maker of software are up more than 250% this year. That's despite questions around Palantir's sky-high valuation and the sustainability of revenue growth. And finally, let the games begin again. For the creator of Squid Game, the most popular show in Netflix's history, writing and directing the first 9 episodes was so intense that he lost 7 or 8 teeth. But he put his dental worries aside to write more episodes, and on December 26th, an equally violent second season is set to hit the screens. Probably good news for Netflix, maybe not good news for that guy's mouth. Anyway, coming up, I'm really excited for this conversation. We'll be speaking to the CEO of Brooks Running, Dan Sheridan. He joins us next. This is Bloomberg. Well, one of the world's leading running brands is in a whole new race. Brooks Running crossing the $1 billion revenue mark for the first time before the start of the fourth quarter this year, and that success due in part to a 10% sales increase in North America. For more on the company's success, I'm pleased to say we're joined by Dan Sheridan. He is the CEO of Brooks Running. And Dan, it's great to have you with us. When we think about how far you've come this year already, is the pie growing, or are you stealing share from some of your competitors?
Yeah, good morning. Thanks for having me. It's a little bit of both, to be honest with you. This category is incredibly strong, and it really comes from the participation in the sport. We're seeing more people around the world choose health and wellness. And Brooks, to be clear, has been on this trend for over 20 years. You know, we've been a brand that's grown almost 15% compounded over that time frame. And so these results are just a continued focus on this category. We're so fortunate to be focused on a consumer that's healthy and a category that's healthy. So we're doing a little bit of both. We've got wind at our back, but we're absolutely stealing share from our competition.
Well, let's talk about a potential headwind, and I'm referring, of course, to tariffs, the possibility that, especially for goods coming from imports coming from China, 60% levels next year. When you think about what that would mean for retail, for shoes, how are you planning around that?
Yeah, you know, for Brooks, we're a global company, so we focus a lot on global trade and policy, and tariffs are something that we deal with every single day here at Brooks. And, you know, if there was to be an increase, which it looks like there will be, you know, what we focus on is our supply chain, creating redundancy throughout our network, creating agility as well. But the truth is, for the whole category, not just for Brooks, this would be a headwind for us. And, you know, we already have high tariffs on footwear. You know, out of Vietnam, we pay about 20% on a tariff basis. Out of China, it's 27%. So if these tariffs come through, it will impact us as a brand, but it'll impact the entire category of performance run.
Hey, Dan, what level would tariffs have to rise to before it became or for it to become economically feasible for you to make your shoes all in America? I mean, at what point do you say, okay, that tariff is too high, we're going to make these shoes in Seattle?
Yeah, we talk a lot about that, Matt. You know, what we're focused on, though, is really trying to get closer to market throughout our entire supply chain. So there's a number there that you know, we model out. But the truth is our entire supply chain and the industry's supply chain is in Southeast Asia. And to move that closer to market domestically would be really challenging. The entire supply chain through tier 2, 3, and 4 is throughout the Southeast Asian market for performance runs. So the truth is it would take a long time for us to get domestic in our manufacturing base.
Dan, I understand you've recently said that you can't pass off the total cost to consumers, but you know, you look at your website, a pair of women's adrenaline running shoes are $140. Post the new set of tariffs, what would that price be?
Yeah, I mean, we look at it in terms of the trends in the market and the category specifically, and the truth is, Sonali, that we would not be able to pass all of these tariff costs onto the consumer. So we're lucky. This category is growing really healthy, above $130 in a rolling 12 months. It's growing 38%. And so we do have some pricing power because performance matters, and we sit in the center as the leader of performance run here in the U.S. And so pricing's one of the models we work on. And the truth is we just wouldn't be able to pass that on. We'd have to eat some of that cost, which impacts our organization in terms of hiring and R&D and the like. So again, tariffs would be a headwind for this category.
Well, definitely hope to speak with you about that once we get some clarity on tariffs. But I want to talk a little bit more about the competitive landscape, because you said at the start that it's both a combination, your growth of taking share, but also the category growing overall. But when it comes to how you sell shoes, you think about what went wrong with Nike, for example. They cut ties with many of their retail partners. Have you been able to fill that shelf space? Are you selling more at stores that maybe aren't Brooks specific?
Yeah, so we think about it maybe a little differently. You know, we set up first and foremost focused on the runner. And the runner is the customer that we have a maniacal focus on for a lot of reasons. One, it's a pretty consistent growth trend over a 20-year period. We're growing about 10% right now throughout the world. We're the #1 brand in performance run. And the reason we are is because we set up as a multi-channel brand. We sell across channel simply because the runner researches brands, they purchase brands, and they try brands in every channel of distribution. And it's important to our strategy to set up locally because that's where running happens, in the local markets. And we always say there's about 10,000 communities of runners around the world. And we're executing on behalf of those local markets and winning. Here in the U.S., we're the #1 brand in market share for run.
Yeah, and I mean, it's a great point that you think about the average runner. They go to their local running store. They try, right. They test out shoes. It's interesting, though. You think about, you, of course, started as CEO sometime in the past couple months in April. I believe it was in June that you told Fortune that you're taking a look at Brooks and thinking about merging into lifestyle brand territory. Talk us through that decision tree about deviating away from the core mission of just running.
Well, I would tell you this, that our focus is performance run. Every single day we get up and all we think about is runners here. It's very unique against our competitive set. We aren't focused on other categories in sporting goods. And so our groups every day build product that will work on the run first and foremost. But we're also addressing a broader consumer set, walking, the gym, all of the categories that running shoes are used for. And what we've seen over the last 4 or 5 years is just an explosion in the broader use cases. And so what we're doing is we're anchored on performance run, and then we're expanding our brand to anyone that puts one foot in front of the other. And that's why we're getting these results and winning the runner every single day in these channels.
You know, speaking more to the competitive landscape, your rivals are changing quickly as well, and some of them have seen kind of choppy uptake. You think Lululemon in the shoe business, you think Nike with the new CEO, and you think about the way that they are trying to double down on footwear and on lifestyle. How do you feel like you will have to react over the next year or so?
Yeah, we have a saying at Brooks, sharp focus creates mass appeal. And so our focus is our advantage. And every single day we focus on this consumer. And the truth is product wins. Product wins every single day with the runner. It matters every day whether the shoe is going to work for the runner. And the worst thing that could happen to a runner is they get injured. So we design shoes based on science first and foremost. And our competitive advantage is that we're really good at that. The secret sauce for Brooks is fit, feel, and ride. Every single day, a runner chooses Brooks, and we've been able to do that. So when we look at the competitive set, we're really competing in product and brand. And right now, we've got a product pipeline that is winning around the world. We just launched a Max shoe called the Glycerin Max, which is absolutely an innovative product that is winning runners every single day in every one of our markets. You know, in China, we had the #1 shoe on Tmall with the Glycerin Max when we launched it. So you can see how it's resonating in all the markets.
We're going to get a pair of Glycerin Max shoes for Katie and have you back on in a couple of months after she's put some miles on them. Dan, thanks so much for joining us. Dan Sheridan there of Brooks talking to us about the running shoe market. Right now, I want to get a check on what's going on in the stock market. And for that, we go back over to Bloomberg's Abigail Doolittle. Abby?
We're seeing relatively small moves across a lot of different asset classes. At this point, we have the S&P 500 down slightly. Earlier, it had been higher. But overall, that Trump trade that started on the election day, and actually you could argue before that, mid-September, really basically in place, even with this small loss. Yields not as much, but it's a small move to the downside after PPI and other considerations taken into account at 442. NYMEX crude off of its highs up just a bit, and then the dollar slightly higher. This is another piece of the Trump trade. If we go into the Bloomberg terminal and take a look at what's been happening with the dollar both in the month of November and October, right now we are looking at back-to-back 2% gains. The first time we've really seen something like this going to mid-2022. So the expectation of a Trump administration being protectionist, supporting that strong dollar, well, right now we are certainly seeing that in spades. And then finally, beneath the surface, lots of movers. Disney shares popping higher right now, up about 8.1%. They beat top and bottom line expectations. In addition, the EPS growth, the earnings growth for this current quarter expected to be high single digits versus the Wall Street estimate of 4%. Parks okay, streaming good. Charles Schwab up 3.6%. They gave their their October monthly update, and they do have $24.6 billion in core new net assets, investors liking that. Super microcomputer, on the other hand, down 7.9%. More bad news here, sort of expected bad news, I would say, in terms of their delaying the 10Q filing and delisting from the NASDAQ. Well, that's a real possibility. And then Hims and Hers down sharply, down 15%. This as Amazon provides some competition entering the telehealth space.
All right, Abigail Doolittle, thank you so much. Now, coming up, AI's impact on the entertainment industry. We'll hear from Jonathan Taplin of the Annenberg Innovation Lab next. This is Bloomberg. All right, it's time for our daily Wall Street Week conversation. And generative AI is being implemented across multiple industries, including entertainment. David Weston spoke with Jonathan Taplin of the Annenberg Innovation Lab about AI's threat to those in creative fields.
They're going to certainly employ it in the production end of making animated films, making special effects for, live features. And so in that sense, it probably will be productive. But obviously, the two strikes that were in Hollywood last year were about trying to preserve the profession of actor and trying to preserve the profession of writer and not have that overtaken by AI. Whether that battle will continue for another 5 years is an open question.
Generative AI, of course, requires enormous sophistication and computing power. Is it possible that the high-tech firms, the so-called hyperscalers, may actually take over a lot of the roles that are now played by entertainment companies?
Well, certainly many companies have found that it's speeding up their code writing. So in the simple sense of writing new code, AI is helping that. But on the other hand, many companies have tried to adopt ChatGPT and stuff like that, and many companies have decided it's not really worth the money. So, I mean, I think the jury is still out. There's obviously extraordinary hype artists like Elon Musk who are very good at promoting things, pushing it. But whether it will end up being the save-all of the industry, I don't know. There's clearly billions of dollars being invested in it, and whether it turns out to be pets.com or it turns out to be Google is an open question.
So we're on Bloomberg. Give me some investment advice. I mean, as you suggested, big tech is a big investment opportunity right now. Does generative AI make the entertainment industry, whether it's the movie studios, it's TV, it's music, does it make it a better investment or a worse investment?
Well, look, in the financial sphere, obviously, AI has been used for years. I mean, someone has told me that, 70% of the trades on Wall Street are done by machine. So it's clearly been very successful in kind of pattern recognition and things like that. So in the financial sphere, I think there's no doubt that AI has been very useful. But whether it will transform the companies and whether if it actually eliminates the kind of mid-level jobs, what will the society look like in terms of, do we have to have universal basic income?
And that was Jonathan Taplin speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's get a check on these markets right now. The color is still red. You take a look at the S&P 500, pretty much unchanged on the day, maybe a hair lower. Same thing, too, if you take a look at the NASDAQ 100, currently off about 0.1%. We have come so far over the past several months, but now, of course, taking a little bit of a breather. We'll see what the next catalyst for these markets is. And then you take a look at the bond market. Again, the epicenter of volatility over the past few months. And that's where the action is relatively today. You can see.
But there's none. Why is everybody so chill today?
I don't know. We're through the election. We're through the Fed meeting. We're getting economic data that's pretty much in line with expectations. Earnings are okay.
Is anything coming up? Do we have to worry about anything tomorrow?
I mean, that was what Mike Wilson was saying. What's the next catalyst, right? I mean, that's what everyone's hanging their hat on.
What was Sitara telling us? That we're just going to be range-bound until year-end. But we're going to try our best to keep this exciting. Let's talk about Elon Musk. That's an easy fix. Supporters of Elon Musk, they're on a buying spree in some of the most speculative parts of this market. The Destiny Tech 100 fund has been one of the biggest beneficiaries. It's a closed-end fund that's publicly listed. It surged over 150% in a week. It holds shares of private market unicorns such as SpaceX. Joining us now to break it all down is Bloomberg ETF reporter and so much more, Vildana Heinrich. Great to see you on set. Usually we sit back-to-back at the desk, so this is thrilling. I started with Destiny Tech. But talk to us about all the ways that people are bidding up things that are even somewhat loosely connected to Elon Musk.
Right, even if they're tangential in some way to Elon Musk. Because, for instance, Bitcoin is ripping higher for a lot of reasons. It's not something that Elon Musk is talking about as much anymore, but it's another thing that's been a beneficiary, as, of course, has been
Dogecoin, which crossed $1 billion in market cap once again, just among this euphoria. It's a lot of retail traders who have been sort of emboldened post-election to put money behind some of the Elon Musk things. I talked to a retail trader earlier this week who said anything Elon touches turns to gold, and so they're putting money behind Tesla, 2x Tesla, these closed-end funds that hold SpaceX, just anything tangential to Elon Musk has been doing really well in the last week.
I have to say, do you remember when Elon Musk went on SNL and the price of Dogecoin shot up? I thought that was the top. I was really wrong.
You thought that was peak hype for Elon Musk? I actually heard yesterday Lisa Camuso-Miller, who is supposedly a Republican strategist, was on Balance of Power and was like, he messed up X and he messed up so many other things. And I was like, wait, he's done so well in everything he's touched except for X.
I don't know about X, yeah.
I wonder if there's any way to get exposure. You wouldn't want exposure to Twitter, right? But you would want exposure to SpaceX, and that's what you're seeing in the Destiny's Child ETF. So
Destiny's Child, yes.
How has it done? Is it soaring? I mean, does everybody want a piece of it?
It's soaring today. It's down, to be fair, and you can. That's maybe exemplary of something shooting up 40%, 60%, and then you'll have a day like today where it's maybe down 12, 13%. Just huge moves. It's exemplary of the huge moves that we're seeing, but it holds shares of private companies.
It says it does.
Pre-public companies, yes. So SpaceX, OpenAI, Impossible Foods, I think, is in it. But people want a piece of SpaceX, and this is one of the ways to get it.
Very hard to get SpaceX shares. There's no real indication that it would go public anytime soon. They keep tendering their shares to create some liquidity. But you look at this fund, the Destiny's Child, right? Destiny Tech 100. Is there more kind of like this that is able to get more access to firms like SpaceX in particular?
Yes, Kathy Wood actually has one that's kind of similar, and
that's an interval fund, right?
Yes, but there was sort of beef between the two earlier this year. Yeah. So earlier this year, when the Destiny's Child fund launched, ARK posted on Twitter something about how it could be too good to be true. The ARK fund also has shares of private companies, including OpenAI and SpaceX. It's underperforming the Destiny's Child fund, but
we're going to stick with that
yes,
from now on. DXYZ is the ticker.
You can rename it if you want. Yeah, sure. But there was beef between the two, where she was noticing, because what you're really after is the retail crowd, and you want to get their attention. One way to do it, obviously, is on X, Twitter.
And because the retail crowd, it's too difficult for them to get to private markets, right?
A dream merger that people are starting to talk about. This is not a real thing, but X and DJT.
Yes, that is something that people have been talking about. I don't know how serious that talk is.
Yeah, we're probably not going to ask Vildana about that, but it was really rare to see, especially ARK, which is an established ETF issuer, come out and publicly criticize an opponent there. But you think about all these different wrappers. You have a closed-end fund, you have an interval fund. There's pros and cons to both. Vildana, it's great to see you. That is Vildana Heinrich of Bloomberg News. And tune in to ETF IQ every Monday at 12 p.m. Eastern. Meanwhile, these markets, we could just talk again about how boring they are because volume is low, stocks aren't moving much. What the next catalyst
Look at Disney was up at 1.12%.
That's true.
And I still think it's extraordinary that, I mean, they beat, of course, almost everyone beats, but they also gave an outlook of high single-digit profit growth next year, which is more than the street was looking for, and double-digit profit growth in 26 and 27.
So idiosyncratic moves. It feels like the index level crickets, but then you get down to the single stock level, and there's more stories.
Have you seen Wolverine and Deadpool?
Absolutely. I am a big Margot. My dog's name is Loki. You know that,
that's
right?
true. Yeah.
But you think about these markets, and we had economic data as well, guys. November 11th, we're in a sweet spot. Let's see if we stay there.
Yeah, I'm excited because tomorrow Peter Rawlinson is going to come in. The CEO of Lucid Motors is going to talk to us. That's our C-suite conversation. Plus, Michael McKee has an exclusive interview with Boston Fed President Susan Collins. So a lot to talk about on a Friday. This is Bloomberg.